Give everyone just a second to log in. All right, welcome everybody. Thanks again for being with us for our quarterly economic and market update. We are going to be looking ahead and looking back as we begin today's presentation. Coming to you today, I've got myself, Chris Boyd, and Brian Regan, our first Chief Investment Officer. And wanted to give you some introductory thoughts just as we did. Want to remind you that as we go through the presentation today, if you have any questions, don't hesitate to use the buttons for the Q&A or chat. We will be made aware of the interest or question that you have. Or if you want to be asking your question verbally, you can raise your hand to be unmuted. We generally will do those kind of questions at the end of our presentation today. We are also recording the presentation, so don't forget that it will be shared on our website and YouTube channel, and so your participation implies consent. Sort of our compliance reminders there. One other reminder that I wanted to provide you before we get too far along is to let you know that this time of year, oftentimes clients are looking for their 1099s from Ameritrade Institutional in particular. We want you to know those will be mailed generally mid-February, but sometimes they are posted to your client portal early. So you may want to check through your TD Ameritrade access. If you did not have withdrawals or taxable events, there may not be a 1099. Only relevant equity it creates a 1099. So I would encourage you maybe not to submit your taxes right away, because it's not uncommon for revisions to a 1099 to come out sometime in March. And so you may want to bide your time a little bit to make sure that you have everything completed accurately. If you are using some kind of tax software that you'd like to import data, there's a unique username and password that you'll need for that kind of access. So don't hesitate to contact our office for help with that. Let me jump into today's presentation and get things started here. I wanted to give you a sense of what we're going to talk about today. We do have a little bit of a review of 2021 to get us started. In addition, we will be kind of looking at some of the economic indicators that are in our focus. Certainly COVID hasn't gone away, and we'll talk a little bit about that. Inflation and growth is certainly on everyone's mind, what to expect, how we might prepare for how to deal with that, position our portfolios in regards to that. We're going to talk a little bit about the domestic outlook for equities and international stocks. One of the questions we get oftentimes is, well, why do we have international stocks, or why do we have bonds? We'll take a few minutes to talk about some of those kind of questions, and whether it makes sense to use alternatives along the way. And of course, our key takeaways. So, and there'll be an opportunity for questions at the end as well. So let's jump in. 2021.
So I'm going to go through these a little bit quickly, Chris. But let's talk about 2021. It was a great year. The S&P 500 returned almost 29%, 28.71. The MSCI ACWI, which we prefer to use over the S&P 500, returned 18.67%. The Russell 2000, which is a small cap index, returned 14.82%. The All Country World Index, excluding the USA, so really everything that's not a domestic stock, returned 7.82%, so still good. The bond aggregate index was negative by 1.54%, and the emerging markets was negative by 2.22%. For our major active allocation strategies, we are very, very pleased with the performance that we saw there after fees. 16.66% for our model portfolio, 85-15. 12.62% for the 65-35 active allocation model, 50-50 8.84% for the 50-50 model, and for the 30%, 70%, we got the 4.88% for 2021. So one of the things I want to highlight in this chart is the relative volatility. So you can see that the purple line is far less volatile in its returns than the green line. So when we talk about, what kind of volatility that you can take and your risk assessment, really consider, are you going to be the type of person that's going to be able to take those kind of significant drawdowns that you can see in the green line, or would you be more comfortable with one of the other lines, and really contrast it with that purple line at the bottom that has really minimal changes in volatility throughout the year.
Brian, one other thing, just as a compliance point to point out, I'm not sure if you mentioned that this assumes a 1% charge on the account as a fee schedule. And so these are net of fees based on that assumed rate of expense for services.
Yeah, this also doesn't include all our active allocation strategies. We have a 60-40 and we have a 50-50 dividend strategy as well. And if you have questions about your own individual performance, I'm happy to talk about it for the year and try to dissect, how yours might be different from the model here. So we do have individual stock portfolios for larger portfolios, and some of the standouts was Simon Property Group that almost a double, 95.77%, Applied Materials 83.61%, Pfizer 66.74%, Alphabet 65.3%, Schwab 60.21%, Broadcom 56.43%. Rounds out some of the best performers that we had in that strategy. Simon and Schwab were deeply undervalued and continue to have consistent performance. Broadcom and Applied Materials are beneficiaries of the semiconductor boom. Alphabet has benefited from a boom in digital advertising. And finally, Pfizer is repricing because of the COVID vaccine and antiviral treatment that has gotten a lot of press, and it obviously has done well for the stock. So it wouldn't be fair to talk about the best performers without talking about the worst performers. And I think the one that stands out is Emergent Biosolutions. Due to some company operational issues, the stock really suffered throughout the year. We're no longer in the position. Some positions that we're still in, Disney, PayPal, and Silk are dealing with different types of COVID issues. Disney obviously has parks that are limited. PayPal had a boom during COVID and now is experiencing maybe a perceived hangover from the boom that it had. And Silk is a therapeutics company, and they can't really operate while COVID's going on, which has been the drawback for them. We still own the latter three companies there. Chris, I think this is important, this slide here that you're going to discuss, because I think our theme for this quarter's presentation is, talking about how 2021 was an exceptional year, and it might be a reach to expect that in 2022. And we want people to reassess, their risk profile and make sure that they're where they should be and what's right for them. But we talked about some biases that we experienced during 2021 and how to avoid them. And maybe you want to go into a little bit more detail for us.
Sure, it's a great point. I think, reiterating that point that, we had a great year last year in markets and our strategies as well. But, it is one of those things that we kind of got a couple of years performance in a single year, which is great. But, we might expect more muted returns. And certainly it's a difficult economy to navigate what to expect from stocks in general. All of the investments is, it's just one of those circumstances where we have to be more willing to anticipate volatility than we've had in recent months, recent years. So let's expect that. As we look ahead, you can't help but look back, though, along the way. And, one of the things that is a common challenge, and by the way, Brian did a great article on this that is probably available through our website if you want to check that out. But, there are a lot of challenges that people face. One of them is their own political biases. We can get, really focused on whether we're rooting for the red team or the blue team or whatever it might be. We can find that our own political perspective can influence our outlook for the economy or investments. And sometimes that can be disruptive, cause us to take more or less risk than maybe we ought. And last year we saw numerous occasions where people were drawn to investing fats, where there were, fabulous returns and then, just disastrous declines. So you want to think twice before you pursue some of these kinds of opportunities or risks that might seem appealing. You're better off trying to get what's your good game plan and stick with that game plan. That's at least the approach we'd like to encourage you to take. And if you want to do something speculative, do it on the edges, but not necessarily with the core of your portfolio. I think those are a couple of the key ones. I think inflation is probably something we're going to talk about later in the presentation, Brian. But it's certainly been on people's minds as we think about, should we be reacting to that? And we've had a somewhat modest response to our worries about inflation in that we haven't thought it's going to be long lasting or something we need to overreact to. Anything else you wanted to highlight, Brian?
No, I think you did a great job. I think that the final one, the glass is full mentality. We're probably experiencing a lot right now after a great 2021. But I like to say that even if the glass is full, the glass can get a little bit bigger because GDP grows, earnings grow, and the market grows over time. So you like to talk about this return to the mean theme sometimes, and I like to say sometimes the mean shifts and changes. And that's
I think that's one of those worries people have. Will we have a reversion to the mean? Therefore, must we have declines after we've had such a great year? It's really important to remind people that it's not absolute. It doesn't happen necessarily. It must happen sequentially. We will have declines, we know, in the future. That's just inevitably part of the process, but it doesn't have to be necessarily just immediate or on the horizon at our current situation.
Great. So we're going to go through a lot of economic indicators. We're going to start with COVID, but what I really want to do is kind of tee up the story that we're seeing right now. So COVID's more contagious, but it's less dangerous. And that can actually be a good thing for markets. The first half of 2022 is going to slow from 2021. We had a pretty outstanding Q4 of 2021. We're going to have some fiscal drag. There is going to be a tightening cycle. We are still experiencing some effects from Omicron. So we can expect to have slowing but continued high inflation. And what do I mean by that? Well, we experienced for the last decade prior to the pandemic, inflation below 2%. I think inflation is likely probably going to average over 3% for 2022, but that's down from the 4.8%. I'm talking about core PCE right now that we're experiencing right now. Earnings growth will moderate. There will be some multiple contractions. So that's just a fancy way of saying we're going to have earnings growth, but it's not going to be 70% year over year or 35% quarter over quarter that we've been experiencing. And multiple contraction just means that if interest rates go up, if spreads go up, stocks will start to be valued, at a more modest valuation. So one of the things that we're doing to combat this is we're eliminating overweight to consumer discretionary. There's no longer excess savings in the market. We're going to continue to overweight mega cap tech due to high margins and moats and quality balance sheets and all of those things in a more in a less stable environment that we've had over the last couple of years. Our equity allocation will continue to be equal weight, but the beta, which is a measure of relative volatility, will come down a little bit. But still, we're not doing anything too crazy on the risk spectrum. We do think overall we're going to have positive returns from stocks for the year, as we do 80% of the time. But it's not going to be as well. It could be, but very unlikely that it's going to be as robust as it was in 2022. For the fixed income portion of our portfolio, we won't be changing too much. So first things first, I think we do want to talk about COVID-19, what's going on right now, how it's different from what some of the spikes that we've seen in the past, which I think is an important distinction. Chris?
Well, COVID-19 continues to be a concern to the market, but we're in a very different position than we were a couple of years ago. Although we're seeing dramatic increase in cases, and this slide is illustrating how we've just seen an explosion of new case count relative to our prior highs. The severity of the implications due to the this variant, the Omicron variant, is less significant in its disruption, let's say economically anyway. If we can go to the next slide, I think there's other things to be looking at, whether it's impact on hospitalizations and death count. The amount of deaths that we're seeing from this variant is far less. That is in part perhaps due to many people being vaccinated. It's in part because this variant seems to be less severe in its health implications. When it comes to this slide, we're seeing that there's a lot less impact over time, and the unvaccinated, even among the unvaccinated, although there's a dramatically greater concern for deaths, it is less so than it was previously. So it's having less detrimental consequence. That's not to say it's not insignificant, or that it's insignificant or that it's not consequential. And it's certainly a concern for the market that it can disrupt workforce productivity and things of that sort. But it is not necessarily as severe as we've seen in the past. So there's I think some expectation, some perspective that things are getting better as it relates to the impact of COVID, and likely to be less a concern as we look ahead when it comes to economic disruption. Brian, anything you want to add to that?
I think you did a great job, Chris. So I do want to talk about inflation and growth. I think this has been a hot topic as of late for sure. So no doubt about it, inflation is high at 4.6%, and core PCE measure is what I like to stress, because that's what the Federal Reserve stresses. But stacked on top of the pre-pandemic, it's about 3% year over year. So what do I mean by that? I'm basically saying what was inflation 2 years ago? What is it now? What's the annual rate there? It's about 2 years, right? And it's a little bit over 3 months. Over 3%. We have seen month over month change in the blue line down there actually declined. And the market, even though we had a very significant headline number when the year over year data came out, the market reacted kind of positively to the decline month over month. They're looking for the signs that it's getting better in the short term. Now, we have this interesting employment situation now that there's about 2.7 million people not working that were working pre-pandemic. So there's a lot of people. There is room for additional growth if these people can get off the sidelines. I think that it could add 150 to 200 billion dollars in GDP if we can get these people back to work. Presumably, they're not working due to pandemic reasons. Older people that would be working, but they decided to take themselves out of the workforce because the pandemic affects older people more than it affects younger people, and why take the risk? It might be what they're thinking. But it's, when you look at the data, one of the things that's very, very starkly clear is that people with that are child providers are definitely out of the workforce, particularly prime age women. So hopefully, as the COVID situation improves, as Chris, did a great job talking about, that it is slowly improving, that these people will start to slowly come back into the workforce. And we've seen that a little bit. If you look at the orange line, it is ticking up, but it's just not doing it overnight. So here's the Q4 GDP estimate. We're going to have a gangbusters quarter. We're going to probably likely be north of 5%, but probably we're going to be closer to 6-7%, according to the Atlanta Fed and the blue chip consensus. So that's great. I mean, great Christmas season, right? The weekly economic index is showing much of the same, going to be north of 6-7%, which is fantastic. It's going to round out a great 2021. But I think it's important to realize that when we talk about inflation, when we talk about growth data, it is past data, which is an important distinction. And we're going to go over a little bit about what to expect in 2022 as well. This is a wage growth tracker. Wages are up, and I think overall this is probably a good thing, but it's also going to affect your inflation outlook. We're looking at north of 4% now. During the dot-com boom, we were at over 5%. Hopefully, we're definitely trending on reaching that. But we're definitely hit a high that's closer to where we were before the financial crisis. It's amazing to think that we never reached the high in wage growth that we were prior to the financial crisis, which was a pretty long time ago at this point. Now, this is, I think, the most important slide on that we have in this deck. What we're going to see is a dramatic fiscal drag in 2022. We spent about 12.4% of GDP in the federal budget deficit in 2021, and in 2022 it's going to fall to about 4.7%, and that's going to take out about $1.5 trillion in nominal GDP growth. So that basically cuts your growth from 10% to 5% in between 2021 and 2022. All things equal, and if we if we have inflation that's closer to 5, which we do now, that takes away a lot of your real GDP growth, and most of it's just changes in price. If it moderates down to 3, then we're going to be closer to our long-term trend. Let's talk about the domestic equity outlook. Chris, I think you do a great job every quarter talking about this next slide for us.
Well, let's talk a little bit about, let's dig into multiples. I think this is one of the things that we're looking at. And I think that when we think about investing, oftentimes we kind of look at this issue of, is the market properly valued? How do we make sense of this? And the long-term average, we're definitely above that. Of course, as Brian has pointed out in previous occasions like these, we're in a very low interest rate environment, and that can allow for a higher multiple without it feeling improper. As we expect interest rates to rise, as you pointed out, Brian, we might expect that multiple to get lower, and or the markets to feel that they need to be at a different valuation. So that's likely to come, we think, more from earnings growth than worry about disruption in the market. But it's something we have to watch. Again, what is this really? What are we measuring? The productivity of a company, its earnings relative to its price. And that's what we're trying to talk about here, that, will that earnings continue to grow to justify the pricing that stocks are likely to show? Anything you wanted to add into that, Brian?
Yeah, the only thing I would add is, this is a 25-year average, and I'd say for the first at least 5 to 10 years, we were more of a bricks and mortar economy, and today we're more of a bytes and bits economy. And what does that mean? Well, that means that you have less capital expenditure costs, and you have higher margins, and you probably have
you can
more
justify a higher multiple, perhaps.
Yeah, so that coupled with lower interest rates is an important distinction. I mean, if you look back at 97, 99, 2000, 2001, the treasury rate was 6+%. Now we're looking at 1.5%. So that's not a small difference. It's a pretty dramatic difference. So, you can see that the multiple there was relatively significantly higher than it is today.
Yeah, that's a really good point.
So this is a lot of the same. I want to emphasize that earnings growth and multiple contraction will lead to your return. We've had quarter over quarter, year over year, quarter over quarter earnings growth of about 35%, with multiple contraction about 8%, which we saw on the previous page, which led to a very, very robust price return from the S&P 500, which is about 27%. Tack on your dividend yield, and you get your total return for the S&P 500 of almost 28, 29%. So it was a very good year. So this same math is going to be applicable in 2022, but the earnings growth is not likely going to be as high. So it's going to be a more challenging year. So again, the theme of this webinar is think about your risk assessment. Are you going to be able to handle the additional volatility? Even if we have a positive year, will you be able to withstand a 20% drawdown in the stock market? I think all those things are very reasonable to expect in any given year, but I'd say especially this year, given a tightening cycle, given the fiscal drag, given the continued variance that we've seen, given that the decrease in earnings growth that we expect year over year, those things are all worth revisiting.
Can I just ask you to elaborate? You've used that term in our correspondence as well, fiscal drag, and I think it maybe overstates what we're talking about, in that there's just a different fiscal environment than we were in last year, where there was enormous amount of spending that entered the economy rapidly. We don't have that, basically, and it's a much different scenario. That's what you're talking about when you refer to fiscal drag?
Yeah, so if you just think of it kind of simply, $23 trillion is the US economy. We spent about 12.7% of that through government spending in 2021. We're going to do, less than half of that in 2022. So, what is that?
A very different moment in time.
Yeah, it works out to about, $5 trillion in 2021, top of my head math. Significantly less than about 3 trillion. And you take off about 1.5 trillion for that. And that's a significant difference in, in what you're going to get for your GDP in 2022. So we have a slowing consumption expenditure tailwind as well. You can see that a lot of that government spending and in those spikes in the top chart there, that was when the government was handing checks to people. Savings spiked. Americans are very good at spending, so they spent it down, and that's what the bottom chart showing is showing that the spending rose with the additional savings, and you can see that the savings came down as the expenditures have risen. Now we're down to a personal savings amount that is consistent with what we've had pre-pandemic. So we think that the boom here is slowing, and that's consistent with what we were saying in the prior slide. The savings rate was up because the government was spending money. The government's going to spend less money, and the savings rate's not going to grow as much. So it's not likely that the personal consumption expenditures are going to keep growing at 16% a year. It's more likely it's going to continue at something like 8%. Would be my best guess. So, let's talk about the S&P earnings expectation. I think 8.5 to 10% is reasonable if you're expecting personal consumption expenditures of around 8%. The S&P 500's large cap stocks with better margins, so you'd expect the earnings growth to be a little bit better. The dividend yield, when I pulled this, was around 1.2%. It might be slightly higher today. The multiple contraction, could be zero. There's no guarantee that interest rates will continue to rise. But I also think that you need to take that into account in your valuation. So what do we expect? Well, the main thing that we're going to expect is that it's likely that the market will go up in 2022, the same as it does 80% of the years. But it's not going to go up, or it's unlikely to go up, in my opinion, closer to 30%. I think somewhere between 1.7 and 11.2% is a reasonable range. 11.2% would be, again, an excellent year, a little bit lower than what we've experienced on average over the last decade, but still an excellent year. And 1.7%, that obviously not as good, but not negative. And it might set us up for, reasonable valuations and expectations going forward. So one of the things that we've been in,
Brian, that's kind of a wide range, though, that you might have, expect relative to your typical expectations, right? Are you surprised by that? Do you think that it's kind of hard? It's a challenging time to navigate a little bit, right?
Yeah, I think, again, Chris, that's why, great point, why we're telling people to, let's make sure that, we reevaluate your risk assessment. Let's make sure that we're in a place that works for you. One of the challenging things after you've had 2 years that have been really, really exceptionally good is I think people have the tendency to continue to expect that year after year. And that's not necessarily the case. And people tend to love taking risk when the stock market's going up, and they tend to hate it when it's going down, which is understandable. But we want you to be in a position where you're comfortable no matter what the stock market's doing. You're comfortable with your long-term plan. Your risk profile is consistent with your goals. And then we can, do some things to try to make your performance a little bit better by positioning in the portfolio. But the most important thing is making sure that you're in the right risk profile. So this is one of the things that we can do to try to make your portfolio a little bit better. And what we started to do last quarter and what we're going to do a little bit more this quarter is have a bigger emphasis on mega cap tech companies. The reason why is because these companies tend to be dominant in their industries. Congress calls them monopolies every single chance they get, which might be a reason not to like them for regulation. But the ultimate reason why I like them in this position is because A, they're priced attractively. B, if we're going to a more uncertain environment, I want to hold the things that have pricing power. I want to hold the things that have wide moats. I want to hold the things that have good margins. And, these companies check those boxes through and through. You might have personal feelings about them one way or another, but the reality is they continue to grow earnings. and they continue to provide returns without their valuations getting too stretched. So, Chris, one of the things that questions that we typically get a lot is, why international equity? It's underperformed domestic equities, certainly recently. So I think we wanted to, be conscious about telling people and addressing these concerns today in the webinar.
Well, I mean, why don't you take care of this and I'll talk about bonds next.
Okay, so the S&P 500 is the index that most people think about when they think about bonds, and sometimes they mentally compare it to the S&P 500 because it's the 500 biggest US stocks. So if you think about it that way, it has some limitations, right? It's all domestic stocks. It's its biggest limitation. The drawdowns can be very significant, and the amount of risk isn't appropriate for most people. So not only is it 500 of the biggest domestic stocks, but it's also very top heavy. So 4 or 5 stocks can make up 20% of the index. And there's a great stat, it eludes me right now, but only a certain amount of stocks make up about 50% of the profits. So it's very concentrated, and it's also only domestic stocks. And what do you get with that? Well, you can get some great returns, but it can also come with some huge drawdowns. So I circled here on this chart some of the drawdowns that we've seen on the S&P 500. This is a great chart from Morgan Stanley. The gray bars show the returns here. But the red shows the drawdown within the year. So you could see in 2020, the stock market was up 27%, but we had a 34% drawdown during COVID. And you can kind of dismiss that. What are the chances of a pandemic again? Well, in 2018, we had a 20% drawdown. And you can see that there's not a small amount of these blue circles. There are significant amounts of time when we have significant drawdowns in the stock market. And one of the things that you can notice is even with these drawdowns, sometimes the year ends positive. So just because we have a drawdown doesn't necessarily mean that we should be running for the exits, but it does mean that maybe we should look for some diversification opportunities to make these drawdowns more tolerable.
You have to also be willing to endure those declines to get to those positive returns. So that's part of that question. Are you willing to endure these kind of volatility? And as much as we've seen rapid recoveries when there are declines in recent years, that's not always the case. It's not always, immediate rebound.
Right. And I think, again, it goes back to the risk assessment question, right? Ask yourself, that hasn't happened in a couple of years. Are you willing to withstand that type of drawdown? I just showed you that it's common. I mean, we like to tell people that you should expect 20% drawdowns in the S&P 500. That would be considered normal. The other thing I wanted to emphasize, it's not like returns have been bad internationally. We've done pretty well. And if you are able to buy at, prices that were depressed coming out of COVID, you did even better. But over the last 3 years, these are some of the returns that we've seen from some of the funds that we've held. So not only have we gotten a diversification benefit, but it's not like they're hurting us. They have done well, 60% over 3 years. From the India ETF, 55% from the Euro-Pacific Growth, which is our core bond fund. I don't consider these bad returns. I think, very happy with them. And if what's more important to me is consistency over the long term.
Just to be clear, these are not annualized returns. These are cumulative returns over that 3 years. So just, that you want to keep that in mind as far as how that calculation works.
Yeah, so on this chart here, I'm just trying to compare, the S&P 500 to the American funds, Euro-Pacific Growth, which is the core fund that we use. And I think there's a few things that are worth pointing out here. First off, the core international fund has more cyclical energy and industrials, while the domestic stocks are very heavy in technology and in communications. Now, this is the case while we're in a growth fund. So we're purposely in a growth fund, but we're still getting diversification by being in more cyclical like names, while the S&P 500 is in more technology and communication. So technology and communication has been good. We have plenty of it in our portfolio, but we do like a little taste of the diversification to try to limit those drawdowns over the longer term. So,
another question often comes up is why bonds? Investors often wonder, they're less familiar, and again, it's worth reiterating, what a bond is, we kind of refer to it as loanership as opposed to ownership. But the primary reason we own bonds for most investors is because they're not stock. And they have a much different level of volatility. Brian has said this in many occasions. It's a great line to reiterate. A bad year in the bond market is like a bad day in the stock market. The level of volatility by comparison is dramatically different. Even in the notion of a rising interest rate environment, it can still be a good idea to have bonds because we expect that incomes will increase over time, will overcome any volatility we might endure. And we've positioned our portfolio to be relatively modest for the level of risk that it might endure when it comes to interest rate risks. What else do we want to hit on here, Brian?
Well, I think we'll talk about inflation a lot, and when it comes to bonds, and maybe they don't want to be in bonds when there's high inflation. The aggregate bond index has returned 32% over the last 10 years. It's far more than the 20% or so that inflation's done. So it's not necessarily the case. And the reason for that is the bond market's pretty efficient. The quote that everybody knows yields are going up, that's not necessarily the case. I mean, everybody might know that the front end of the curve is going up, but that doesn't necessarily mean the longer end of the curve is going to change. And that's a really, really important distinction. It's really difficult to wrap your head around. I understand all that. But I think it is a very, very important distinction, especially when you're thinking about your asset allocation. Most importantly, I look back at the data. There's 2 instances in the last 100 years where triple B bonds have had negative returns in back-to-back years. So we had a negative year in 2021. That means it's about a 2% chance, if you believe the historical data, that it'll happen again this year. There's a chance. It's probably more like
past performance is not necessarily indicative of future returns, right?
You can make the argument that it's more likely because there's a little bit more inflation and yields are low. But that's just some food for thought to keep in mind. In this chart, I love this. This is from Fidelity. You can see that the blue line from 1941 to 1981 showed the 10-year Treasury yield. You can see that it was a long process of yields going higher. And the green bar shows the annual return of bonds. You can see that the worst year was in 1969. It was down 3.2%. I've definitely seen days in the stock market that it's down 3.2%. So again, a bad year in the bond market is a bad day in the stock market. If this is a persistent rising rate environment for 40 years, where the 10-year Treasury reached 13.9%, and look at those total returns, they're quite remarkable. In 1 year, they're following the lowest return period of negative 3.2%. You got an 18% return in the following year. So, bonds are resilient. They can do well even when yields are rising. And the reason for that is because you take the coupons that they pay you and you reinvest them at the higher rate. So, I think you need to be patient with your bonds, and they're definitely still a part of most people's portfolios.
I would point out one other thing too, before you go on, Brian, and that is, this is one of those areas where active management can really add value. How to be positioned, how to navigate dealing with the bond environment. It is oftentimes more challenging for individuals to make sense of in these kind of environments, but it is one of the virtues of what you're paying for when you're hiring a firm like ours and trying to navigate these issues. Not to say that it's always going to be right or not that it's easy, but it's part of what we're trying to do to help you navigate the risk and help mitigate risk in your portfolio, simultaneously.
So here's the yield curve. The yellow line's 1 year ago, the red line 6 months ago, and the blue line's today. So we have seen some steepening in the yield curve. This benefits certain sectors, but it also helps me decide where the bond positioning should be. Typically, you want to be on the fattest part of the curve, so you can get something called roll return. You can also get the highest yield for a unit of risk. It's a complicated subject, but the most important thing to note there is that we have seen rising yields over the last year. Doesn't necessarily mean it's going to continue, but that certainly has been the trend. Not all bonds were negative. So our portfolios particularly had positive returns in 2021 from our bond portfolio. These aren't all the positions that we had from a fixed income perspective, but these are the positive positions that we've had that did quite well for some of them. So particularly the high yield bonds and the floating rate income fund did exceptionally well, but some of the international returns and short-term bond funds also were positive, even if they weren't, high-performing positions. So, this is all to say that you can position your bond portfolio for positive returns with a little bit of active allocation. Now, are we getting paid for the risk is always a question that I ask. During the pandemic, you can see that spreads blew out. When these lines go higher, bonds tend to do poorly on a relative basis. So you can see that we're stable at these very, very low levels. I would argue that right now, we're not necessarily getting paid to take a significant amount of risk in the credit markets, which is why we've decided not to take a lot of risk in the credit markets. We actually eliminated the high yield position in 2021. So we talk a lot about the 10-year treasury, and I know there's some ad nauseum amounts of conversation about it changing. I want to emphasize that, inflation is an important part on how that gets priced in, but it's not just inflation today. In fact, inflation today is, a small part of that equation that determines the price of the 10-year treasury. What's also very important is inflation, even in every year in the tenor of a bond. So if you're talking about a 10-year bond, you're worried about the next 10 years of inflation, not necessarily just this year. And you're really worried about the long-term average or the long-term trend. And what we're seeing here in this five-year forward break-even inflation rate, which sounds like a mouthful, we're just basically saying that what are inflation expectations between 2027 and 2032? And they're pretty well anchored around 2%, where the Fed expects it to be. So, this is saying that even if we have high inflation now, the expectations for high inflation in the future aren't necessarily as high. So finally, alternatives. I don't have a particularly robust slide for this, but I want to point out some ways that we've added some value in alternatives, and we're going to continue to look for alternatives in the portfolio. This is a place where I think is if we do a good job, we can really add some value for the portfolio within your risk preference. We've added gold, real estate, and the merger fund in the past. We're no longer in any of them to any significant degree, but they all added values, particularly gold and the real estate funds. We're continuing to look at alternatives, and right now we're looking at a carbon futures position, which had an exceptional 2021, and I'm really just more concerned about the ability to trade it right now, because I think there's a lot of opportunity there. But what I really want to get across is this: we're going to continue to look and continue to try to add value, where we can. So the takeaways: if you feel uneasy about short-term risk, let's discuss your risk profile. Again, I think the theme of this is let's talk about your risk profile. It's been a couple of years of outstanding returns with not a lot of volatility. I don't want to get, I don't want to get rest on our laurels here. I want to make sure that we are constantly thinking about this. Inflation's high. I think it will continue to be high, but it will decrease. Expect earnings growth, but less robust, likely more volatility. One of the things we're doing to address this is we're eliminating the consumer discretionary position. Again, there's less savings. We're expecting retail sales growth and consumer expenditures to fall. There's likely going to be multiple contraction. I don't think that's a guarantee, but likely going to have multiple contraction in 2022 versus 2021. We're addressing this in beta. We're decreasing our overall beta, which is a measure of relative volatility in the market. So we're going to try to take less volatility as the goal. One of the ways we're doing this is we're decreasing the small cap position. We're going to continue to be underweight, slightly underweight, but we're going to have a continued position in international stocks. I say slightly underweight because when we first started this, our core international position, the ACWI, the All Country World Index, was about 43% international stocks. Because they've underperformed versus domestic stocks, they're about 35% now. So we're actually, since we're going to continue to take the same position, we're less underweight than we were when we started the position. Bonds are resilient and belong in most portfolios, and something really, really significant would have to happen for me to change in that position, because the data is overwhelming. The bonds are going to be they're going to give you an appropriate amount of return for the unit of risk that you're taking. And, for diversification purposes, for asset allocation purposes, I think it's the right place to be. So I'm happy to take questions if we have any. Kathy?
Yeah, I'm going to start you off, Brian, with one question that, and I want to remind everyone, if you'd like to ask a question, you can enter it in the Q&A area, you can enter it in the chat box, or you can raise your hand, and there's a button to raise your hand, and we can unmute your line to give you an opportunity to inquire. One of the things that's in the news today, Brian, is tensions with in the area of Ukraine, Eastern Europe, Russia and Ukraine. We've had questions from clients about prospects of concerns with China and how there may be aggressions and related to Taiwan and so forth. Would you speak to this concern? Just how are we taking this as a perspective of how might portfolios be responsive or plan to address these kind of concerns that are more, geopolitical kinds of issues?
So I think first and foremost, if you have real big concerns about war affecting your portfolio, I think that it is important that we address your overall risk profile, because I do think that's it could happen, but war is typically, or large scale wars aren't typically our base case assumption, but it could certainly happen. And I agree that obviously there's tensions in Ukraine and in Taiwan. Second of all, we're not taking a significant amount of risk right now. We just did the whole presentation trying to emphasize that I don't think 2022 is going to be as good as 2021, and that's reflected in the portfolios. But again, it's reflected in the portfolios at your risk tolerance. So if you have a moderate risk tolerance on our profile today, and you're in something like a 65-35 portfolio, but you really belong in something like a 50-50, then we need to have a longer conversation. But from a specific, what do I think will happen if to the capital markets if we do have a war and with Russia and Ukraine? I think there's going to be a couple things that are going to happen. First, war is it's an inflationary event. So we already have bad inflation, but it could get worse because of that. And it'll get worse primarily in the Eurozone, not necessarily in the United States. And why do I say that is because Russia is a giant provider of natural gas and oil to the Eurozone. And there's likely going to be some significant, tariffs and things like that to economically punish Russia for their actions. Second of all, I looked back on what the market did when Russia invaded Crimea, a former portion of the Ukraine or current portion of Ukraine, depending on how you want to look at it. And the market was pretty unresponsive. So I would caution you of overreacting to, the aggression in Eastern Europe.
Excellent. Kathy, you had identified a few questions. Would you like to ask them, or would you rather I do that?
I'm glad to put them forth, Chris. Brian, one of the things, China has had a lot of Omicron cases rapidly rising recently, and just wondering how that and other things going on in China will affect the markets. That has affected the supply chain, and wondering how the supply chain issues will affect the markets in 2022.
Well, we still have some supply chain issues, and it's a lot of it's pandemic related. And I wish I could tell you that it was all going to get cleared up within the next 6 months, and that would be great. The reality is we are still battling this. I think what Chris pointed out at the beginning when he went over the COVID data is that we are making incremental progress though, and that should help the supply chain issues with time. Unfortunately, it hasn't happened like a light switch. Even here in the United States, we have those 2.7 million people who still aren't employed for pandemic reasons. Now, when it comes to China, I actually think the slowdown that they're having is a bigger issue. I mean, and I think it's more property related, in the debt related, and they're gonna struggle to work that out. Now, what on a global scale, what does that mean? They are the biggest buyer of raw materials in the world. So you could actually have downward pressure on commodities if China has a significant slowdown. And that would be, good for the inflation outlook. But it would presumably bring inflation down as commodities get priced a little bit cheaper when there's less demand, but not great for the region.
Great. And then just one other question, Brian, is some of the big banks started announcing their Q4 earnings this week, and they were all positive. Any insight into that or any trend with that you see?
So, I don't really want to comment too much on quarterly earnings. First of all, because they just started rolling out, and I think the jury is still out on a lot of them. But when it comes to banks, I think the yield curve gets a lot of attention. But what I think, if you're a longer term investor and not necessarily a trader, the thing that you want to concentrate on is deposit growth. And then the second thing you want to focus on is their fee businesses and how consistent they are. And that's why we've preferred things like JP Morgan and Schwab. They have, a vast array of consistent fee businesses, and they've had huge growth in deposit base over the last few years. While while their stock prices were very depressed because people were concentrating a little bit too much on the yield curve. Now that the yield curve is steepened, we looked at it briefly there during the presentation, their stocks have rebounded quite nicely. So, financials have definitely done well recently. I think the, earnings this quarter were, a little bit mixed. They took a lot of reserves during the pandemic and then took the reserves off. So the quality of earnings is usually a question mark. But, again, what's important there is consistent fee businesses and deposit growth. And then the yield curve will do what it does. It'll affect all the banks the same.
Thank you.
I just wanted to point out that if anyone has further questions that they'd like to reach out to us, you can connect with us through the website, amrfinancial.com, or certainly send us an email. Brian, any final comments that you'd like to address?
I just want to say thank you for everybody for, again, another great year. 2021 was an exceptional year for us and our clients. And thank you for trusting us. And we're going to continue to keep it moving in 2022.
Excellent. Why don't we put up do we already do our disclaimer page? We can put that up as we close out. I would like to invite everyone to keep in mind, as we've talked about the items this presentation, that if you have any concerns about how you're positioned with your portfolio, certainly reach out. We can review your risk profile, make sure we've got the right mix of design and structure for your accounts, and evaluate whether there's any need for change. If you'd like to do that, again, just reach out to us through our website, amrfinancial.com, or you can certainly give us a call at 866-771-8901. With that, Brian, thanks for your presentation today. Thanks to our participants for joining us. We hope it's of value, and if you need any help, certainly reach out. Thanks, everybody.